Hey, good evening. Hope everybody's doing well out there. Wanted to do a quick video on a couple questions that we had from an investment club member. So as you can see here, we've got who is using operating cash flow in place of owner earnings for their 10 cap analysis, and how does a 10 cap help me in the grand scheme of things? Know how much I'd pay for the entire business. How does it help me? Is there a calculation I can use to determine how much I would pay per share? Thanks. So 10 cap analysis. Cap analysis in general used a lot in real estate. 10 cap made popular by the famous Warren E. Buffett. He's mentioned it a couple times in his letters and annual meetings. And then further expounded upon by Phil Town in his Rule 1 Investing Brand, and also Danielle Town in her book Invested. So just kind of wanted to go over a couple things here, how I look at it and kind of what I do, and you don't have to do it my way, you can do it your own way. I think that once you kind of understand the basic principles behind it, if you get those down, then if you want to deviate from it, you can use it to fit your style and to justify it. Okay, let's go ahead and get started. Let's dive in. So in preparation for my 10 cap, or for any valuation, frankly, I want to get the right data, and I want to get it in a form that I can manipulate it easily. I'm going to be using Excel, and so I want to come to www.stockrow.com. This is a free website that you can use for all kinds of things. I'm going to go up to the ticker, and I'm going to type in ALK for Alaska Air Group. And the profile comes up. I have all of my data and metrics here that I can look at, a lot of quick reference to take a look at things. But what I want to do in preparation for my own valuation is come over to the Financials tab. I'm going to click on the Financials tab, and right now it's on Income Statement on Quarterly. And if I look down here, I can see here's 2020, here is 2018, and I can see how things go. What I want to do for this exercise is I want to take it to Annual, and I want to download the income statement, the balance sheet, and the cash flow statement. And I want to download it into an Excel file. So I'm going to click this button right here, Export to Excel. And then it'll prompt me to save it. So I will save it. Yeah, I already downloaded it, but I'll do it again. And then I click right here, and it should open up. Might take a second. Enable editing, and now you can see here's 2019 year end, here's 2011 year end. So it's actually 9 years of data right here, and I've got my sales or revenue, even has the revenue growth rate in decimal form, gross profit, SG&A, so forth and so on, down to income tax. I've got my margins, EPS, all that stuff. And what I can do is I can take the lines that I want and then discard the lines that I don't want. So, if I wanted just revenue off of here, I could copy that, put it into a new sheet, and then combine it with, cash flow and assets or other things like that. So I want to get all three of those statements in the Excel format over time to prepare for the 10 cap. Okay, so here is a very non-posh, very simple Excel file with the method for computing a 10 cap or computing a price per share by owner's earnings. So what we're going to do, or what I recommend you do, is you start with your net income, add back depreciation and amortization, then add any other non-cash expenses, and then account for changes in working capital. Working capital is just accounts receivable minus accounts payable. Couple different deviations here. So for net income, I know that in the book Invested by Danielle Town and Phil Town, they talk about using pre-tax income instead. However, I personally go ahead and use after-tax income because I actually went back to the Buffett letters that they referenced in the book, and I can find no indication that Mr. Buffett does not use after-tax income. So that's what I want to use. That's what I do use. I think it's more conservative. You're welcome to make your own judgment there. So depreciation, amortization, it's a non-cash charge, and so that's why it's added back. Any other non-cash expenses, so I probably normally wouldn't do this, but you'll see that in the case of Alaska Aero Group, I actually did add this back, and it's because it was a significant amount. It was about 2% of revenue averaged out over time, and because it was a persistent benefit that I could add back, I did go ahead and add that back. So basically, these would have been expenses on the income statement. They would have been non-cash expenses like depreciation or amortization. They would have actually taken away from the cash, and so we'd adjust for owner's earnings by adding those back, because at the end of the day, we're worried about cash, not theoretical income. Again, changes in working capital, so it's accounts receivable minus accounts payable. I personally don't add this in because I just kind of want to simplify it, and working capital can jump up and down. It can give you distorted value if some interesting accounting is going on. You can use your own judgment here, and as you do these more and more and gain experience, you can kind of get the feel for maybe when you should add it in and when you shouldn't. And then you want to take away maintenance Capex or capital expenditures. So maintenance Capex, in theory, if all was right in the world, would equal your depreciation and amortization. So basically, it's the amount that we're going to spend to, repair equipment, repair plants. Entropy happens over time. Stuff runs down. We've got to basically, in order to get back to square one, we have to put money into repair stuff. It's our upkeep. However, a lot of companies, if you look at their annual reports, don't differentiate between maintenance capital expenditure or growth capital expenditure. Growth capital expenditure being the money that we put in to buy new equipment, new factories, new buildings, new stuff, basically new growth assets that will allow us to get additional revenue in the future. And we'll talk about that separately coming up soon. But what you need to remember for this point is that we want to subtract the maintenance capital expenditures, not the growth capital expenditures. This is going to yield, if you do all this, take the net income, add these, take away the Capex, maintenance Capex, this is going to yield your free cash flow. And what you want to do is take the number of shares, common shares in the company, divide free cash flow by the common shares, and you get your free cash flow per share. Easy enough. Multiply it by 10, and it gives you a price. And that's basically your price per share. And kind of the basis behind the 10 cap is if the current price is at or below your 10 cap price, then it's a buy. And if it's above that price, then you probably want to wait on it. And if it's really above that price, then, well, maybe it's a sell. Okay, so I wanted to do a brief, simple example before we get into the more advanced 10 caps and 10 cap techniques. So for Alaska Air Group, I took the year-end numbers for 2019, and same spreadsheet here, I just put in some numbers and did the math. So net income, added back depreciation and amortization. I added those non-cash expenses. I took away, so I know I said use maintenance Capex. I used total Capex, and it's only to simplify it. So in your simplest form, to estimate maintenance Capex, and to do so conservatively, just assume that all Capex is maintenance Capex. And maybe not the best assumption in the world, but you will get a value that is more conservative than you otherwise would have. So it will, all else being equal, it'll make you safer. So if your price is still a buy, it can only become more of a buy under this method. That yields me my free cash flow, which is actually fairly close to net income, you can see. And I looked up the number of shares from the balance sheet, and then I divided my free cash flow by the number of shares. I get $6.30 a share. You multiply it by 10 and get $63 at the year end of 2019. So a couple nuances here that I wanted to go over, because we had some members ask this, and someone said, well, do you use owner's earnings or do you use operating cash flow? Well, if you're familiar with accounting, or if you're getting familiar with accounting, you may realize that this owner's earnings method here basically is operating cash flow right here. These items right here this is your operating cash flow. And so it's operating cash flow, take away your maintenance capex, and that's your owner's earnings, or your free cash flow, as I've called it here. So basically, it's kind of one and the same. And if you want a quick way to do this, you can just take operating cash flow, subtract total capex, divide by the number of shares, multiply by 10, and call it a day. It is fairly simple. It's good, and it can be used as kind of an eyeball approach, to see if your company is close in the ballpark or is way off. And so now, if you're curious, what about a year like 2020 when this net income is going to go away? And for an airline, it's certainly going away, and it's probably going to be a loss. Or what if capital expenditures, if I'm using total capex, what if this year it's 655 million, but what if next year it's only 100 million? Or what if it's over $1 billion next year? What if these numbers jump up and down by large amounts of money? And as you'll see when you start looking at businesses, especially with airlines or other heavy capital intensive businesses, they do go through what you would call a capex cycle, where they will build up their capex for, say, 3 or 4 years, and then have maybe 3 or 4 years of light capex. So you want to make sure that you get a good point and not just kind of a low point or a high point in the cycle, which could distort your number. And we'll talk about that next. Let's take it up a notch, shall we? So now what I have is I've taken that data that I got from Stock Row and I've parsed it. And so I've got kind of a cross or horizontal data for my 10 cap over time. So from year end 2019 all the way back to year end 2011. So I've got my revenue at the top right here, and I'm going to use that as a metric basically because I'm going to want to compare things to revenue. Because if I want to scale things over time, then I want to look at kind of how it goes to revenue. Because if revenue grows a bunch, then it could distort my scale if I don't scale it towards revenue. And I also have my revenue growth right here. We will come back to that. So we just did the simple example of the 10 cap. So here we go again. Here's our net income. I went ahead and, like I said, I scaled the net income to revenue. Here's our depreciation, our non-cash expenses, and then I used total capex for this. So not getting into the nuances of growth and maintenance capex yet. We're just going to keep it simple for now. Total capex. So I add that line, this line, this line, this line together. I get my free cash flow. You can see it over each year here in the red. Here's the number of shares. One thing you want to be tricky, that could be tricky that you want to account for, is the number of shares can change over time. So as you can see, indeed, it used to have more shares. So you can get that off the balance sheet data. I put that in, you get your free cash flow per share, multiply by 10, and get the 10 cap price. And immediately you should see something that might put your belief in this method of valuation in doubt. And that is, if you go back to 2011, my price was over $20, and then immediately it dropped down about 40% to over $12, and then it slowly climbed back up, and then it started accelerating again, and then we got off to almost nearly $50 in 2016, and then we kind of dropped off, culminating in a crater in 2018 at under $10, and then suddenly back up to $63. So this kind of gets back to what I was talking about with, CapEx will change every year, and you want to make sure that you use a sustainable value. And net income will change every year, and so will non-cash charges. So you want to try to find what would these values look like in kind of a base year or an average year, and you want to make sure that that's a base year or an average year going forward, not just the past, because the future could be quite different than the past. And that's why ultimately at the end of the day, the 10 cap is just a evaluation method to give you a price. But if you haven't looked at the data, if you haven't analyzed the business, then this is just going to be garbage in, garbage out. So there is no magic, stock picking genie that's going to give you all the numbers and all the answers just, super easily. The game of investing is hard. You got to put in the time and the work. And, to make things even harder, you could do everything right, and you could make the best bet, and you could have the odds in your favor, and you could still lose to your neighbor who picks stocks based on astrological signs. It just happens sometimes. But if you're like me, you think this stuff is fun, and that's kind of a good benefit to have. Having fun yet? Let's build some more, shall we? Okay, so I've got a new set of numbers here, same sheet, but so you can see what I've done is, I told you we'd come back to this, but I've taken that revenue that I had up the top and my revenue growth, and I normalized, my net income as a percent of revenue every year. And then I came up with an average. So simple average method. It's not weighted, just equally weighted average. And then I also took the non-cash items, again, came up with an average. And Capex, again, took a percent of revenue and came up with an average. So net income margin was average of 9.8%. Non-cash, just under 2%. And then Capex, this is total Capex again, about 11% a year. So came down and I normalized these values for my 10 cap. So basically I said, what's Capex going to look like if I used the average amount over time? Because if I'm going through a Capex cycle, I've got up years and down years, maybe I'll overpay Capex one year and then underpay the next year. Because, c'est la vie. That's just how life goes sometimes. So if I want to smooth that out, then what I did here is, you can see I took that average number, which was around 11%, I multiplied it by revenue in that year, and then came up with what Capex would look like if we were using the normalized value. And then I did the same thing for net income and also for the non-cash items. For the depreciation and amortization, since I actually had those values every year on the balance sheet, on the income statement, I just went ahead and kept those values. And this gave me new free cash flow per share. I divided by the number of shares, again, using the correct number for each year to get my free cash flow per share, multiply by 10 to get the 10 cap. And now you can see some numbers that look very different than my numbers above. Above, I'm up, I'm down, I'm up, I'm way down, I'm way up. Here, it's kind of a steady, climb up. So, 20, 21, 22, 25, up a little bit of 30, and then so forth and so on, all the way up to 40 in 2019. And so the numbers look more reliable. Of course, you can't average everything in life, but if I want to try to find, kind of what an average year looks like, then I can smooth those numbers over, and it can perhaps give me a little bit more fidelity. So I think I would feel much more comfortable at $40 a share than $63 a share. And, you can see that the changes in Capex or the changes in income, kind of these ups and downs, these statistical fluctuations, they can have real meaning for the price. So you want to make sure that, you don't base your valuation on, a statistical fluctuation. So watch out for those pitfalls. I said before, you want to make sure that we are doing this going forward, not going backwards. So I can look at my, average revenue growth. I can look at my average net income margin. But if I am analyzing the business and I think the net income margin of the last 10 years is too low. Maybe something's changed. Maybe they got, a super new product. Maybe they got, the greatest manager in the world. Maybe they got, something fundamental that changed on the business. And I think that they're going to be able to have super high margins going forward. Or maybe they used to have high margins in the past consistently, and then it dropped off for the last 5 years because someone ran the company to the ground. And, maybe the original person came back, and I think they can achieve their margins again that they did before. So those are considerations that, it's more of an art than a science there. And you've got to know the business. I know everybody says that, but it's those nuances about it that you can use to translate into numbers. I like to follow Professor Aswath Demordren. He talks about stories to numbers. And so to me, it's more than just knowing the business, but taking what you know about the business and then translating that into a metric. So, maybe that's having to do with revenue growth, maybe it's margins, maybe it's something else. Same thing for capital expenditures. Maybe they had super high Capex in the last 10 years because they built a bunch of new planes, and those planes are supposed to last for 20 years. I don't know. And so maybe it'll be a while before they have to spend a lot more money on Capex. You just got to take what you know about the business and then translate it into the numbers and then project it forward to get your valuation. Let's talk about maintenance Capex versus growth Capex. Finally, I know, right? Since I told you to use growth Capex or I'm sorry, to use maintenance capex to take that away in the 10 cap, and then I went ahead and used total capex. But that's because maintenance capex and growth capex are a little bit more nuanced. They're not always clear. So there's a couple methods you can use to try to find growth capex and maintenance capex breakdown. Of course, you can look in the annual reports, and sometimes management will tell you. They'll say, okay, this is how much was for maintenance capex, this is how much is for growth capex, here's our breakdown. And they'll even estimate it going forward. You know, there's pros and cons to this. The pro is that it's really easy to find. Cons are, well, now everyone else has it too, but also you have to ask yourself sometimes, is management giving the right numbers? And management may even think they're giving you the right numbers, but still could be wrong. And so the truth could be off a good bit. Management is often influenced and biased by certain incentives, certain biases, certain facts of life. And they may be aware of it, they may not be aware of it. But you should be aware of it as a valuation detective. And so I'm a bit skeptical sometimes about management's guidance. I could use it as a baseline and to help inform my analysis, but I want to go a little bit further. And we'll come back to that. You could use depreciation as a proxy for maintenance capex. So, like I said in the beginning, in theory, your depreciation should equal your maintenance capex. In reality, it's often very different, but it can kind of give you a ballpark figure for what maintenance capex would be. Just be careful, because for a lot of companies I've valued and I've taken a look at, maintenance capex actually looked like it was much higher than depreciation in some years. The method that I'm going to talk about coming up soon, which I call Look at Reality, is basically we're going to analyze our sales and our total capital in the business, and our sales to capital ratio, and also sales to property, plant, and equipment ratio. I'll also look at the total capital added over time, and this is where it's going to get a little hairy and a little messy. I did want to kind of, as a primer to that topic, talk about sustainable growth versus efficiency growth. So the reason why you can come up with growth capital expenditures, or the breakdown of growth and maintenance capital expenditures from sales and capital, is because in theory, with a business, if I want to grow revenue, if I want to get people to give me money for my products and services, I have to have products and services. And in order to have products and services, I've got to have capital to produce products and services. And I know that, maybe in today's information age, technical age, that might be intangible assets, but it still takes capital to get that stuff. And so for every dollar that I put in capital, I should have a theoretical return of sales coming back to me in the future. And then I'll multiply that by my margins to get income. So I can improve growth by efficiency. I can use the assets I already have, and I can be more efficient with it to grow. But you can only do so much of that. You can only be so efficient before you can't be anymore. And in a lot of times, you can often be less efficient. So we want to do an analysis of new capital going into the business and total capital in the business, and how does that relate to sales? And we're going to try to estimate how many dollars of sales we get for every dollar of capital that we get going into the business. And using that, we can relate it to CapEx and try to figure out a growth CapEx and a maintenance CapEx breakdown. I'm going to talk about the sales to capital ratio now, and how I'm going to use that to estimate my growth capital expenditures and maintenance capital expenditures. So, couple preparation steps. So, as you can see on my spreadsheet here, I've got my revenue over time right here. I did my year-over-year revenue growth. I did that in dollars, not as a percent. So, right here for 2019 end of the year, it represents 2019 end of the year revenue minus 2018 end of year revenue. So that was the incremental growth, and then so forth and so on. That's why I don't have the last value here, since I don't have the 2010 numbers. So I also wanted to estimate the total capital that I had, and so for capital I used total debt, total equity, and then cash. So basically I used the cash to create net debt, and this was on the numbers that I got from Stock Row. It's actually on there, which is the total debt minus cash. And so I got those numbers for Alaska Air Group. I got the equity over time for Alaska Air Group. I added them together, which is my capital And then I also computed my year-over-year capital growth in dollar amounts. And so I'm going to use those for several methods. I also took property, plant, and equipment and looked at that over time, and then also the year-over-year growth for that. So that's kind of my base numbers that I'm going to manipulate. So the first thing that I did is I created two ratios. So I did sales to property, plant, and equipment and sales to capital. So I'm going to use the total capital in the business at the time the total sales in the business during that year divided by the total property, plant, and equipment. So I took right here, as you can see, B8, which is revenue, divided by B17, which is property, plant, and equipment. So in 2019, I got this much revenue off of this much property, plant, and equipment. So for every dollar in property, plant, and equipment, I got $1.27 in sales. And I looked at this over time, and you can see this number is actually fairly steady. It goes up and down a little bit, some years more than others, but actually not that volatile compared to some other metrics that we have. So over time, the average value of that was $1.23, a little over $1.23 in sales for every dollar in property, plant, and equipment that I get. So if I want to use that, that could tell me that going forward, if I put a new dollar in property, plant, and equipment, I could expect to have a new $1.23 of sales every year, about. I did the same thing for total capital as well. So basically, I took that total capital that I had up there, and I took my revenue. So again, I took the revenue divided by the total capital, and I get the number for each year. Took the numbers and I averaged them, and I got 2.57. Now, this is actually where I picked up on something that I didn't know, but I Google searched for it afterwards and found something. This is the brilliance of accounting, is that you can figure out things happen just by looking at the numbers alone. So if you can see here, I've got kind of in the low to high threes for my sales to capital, and then all of a sudden it drops off, and now it's in the low to high ones. And so something happened, around this time period, and I wonder what that was. We'll come back to that later, but just something to be on the lookout for. I'm gonna go ahead and pretend like this is a reliable number, the 2.57, that I can use. We'll talk later about why we might want to adjust that. But if I want to use these numbers, I come down, and for the sales to capital method, went ahead and put my Capex here, that total Capex for reference. So I come up with an implied growth Capex. You can see I can't do it in this year, the most recent year, because I don't have the 2020 numbers yet. Although we could probably do it now that 2020 is past. But for the time being, we'll just take a look at the past. So I've got my implied growth Capex here. What I did is I took B9, which was the year-over-year growth in sales. So basically the additional sales in 2019 over 2018. And I divided it by the capital that I put into the business in 2018. So basically my I divided it by my sales to capital ratio. So if I expect to get $2.57 of sales for every dollar of capital, I took my incremental sales, divided it by my sales to capital ratio, and I get my theoretical incremental capital, or my growth capital. Not just my maintenance capital, but my growth capital. So that gives me an implied value of growth capital expenditures. And then I computed that all the way back. I looked at actual Capex that was spent in the year. I subtracted the growth Capex, and then I can get my implied maintenance Capex. And then I also wanted to take a look to see how this compared with depreciation. So I had my depreciation down here. These are the actual numbers. And then I calculated my implied maintenance capital expenditure as a percent of depreciation. So you can see here ranges from minus 25 all the way up to 216%. And then at the end here, I didn't just average the averages. I took the total numbers. So starting in from the 2018 growth Capex and everything else. So I used 2018 back to 2011 since I didn't have the 2019 numbers. And so I took total Capex. So that would be from here over. It's going to exclude that value. And then from here over, summed it up. And from here over, summed it up. And I took the numbers again. So it was total Capex that was spent, my total growth Capex over the time, and then my total maintenance Capex over the time based on the sales to capital method. And also looked at the total depreciation over the time and saw that it looks like implied maintenance Capex was 147% of the depreciation over that time period. We're on a roll, so let's continue. Let's take a look at the sales to property, plant, and equipment ratio method. All right, so we just did the sales to capital method. I've got my sales to property, plant, and equipment over here. The average number over the last 9 years that I have, $1.23 of sales for every dollar of property, plant, and equipment. So what I'm going to look at, I've got my Capex values that I repeated right here, and then my implied growth capital expenditures. So I basically took my ratio, I divided my year-over-year growth in sales by my sales to property, plant, and equipment ratio, similar to how I did with the sales to capital ratio, and came up with a number to estimate growth capital expenditure. Now, this method would imply that pretty much all the capital expenditure for growth is going into property, plant, and equipment. So if it's going somewhere else, it's not going to be counted into this. This would undercount it. So you know, it may work for kind of the traditional manufacturing business, factory, something like that. But in this case, for the airline, I don't think it's necessarily the most appropriate metric. But I wanted to go ahead and calculate it anyway, just to see how it would compare with everything else. So I got the implied growth capital expenditure. I took that away from the actual capital expenditure that we spent in the year, and then got the implied maintenance capital expenditure. And again, I compared it to depreciation to get kind of a percent of how it's going to look compared to depreciation. And this one is kind of all over the place. But in the end, I looked at my aggregate numbers and found that the depreciation is only maintenance capital expenditure was only 72% of what depreciation was reported. So again, that's implying that growth capital is only going to property, plant, and equipment. So if there's stuff going elsewhere, that number would be too low, and I think it is too low, especially given that the sales to capital method gave me about double that. Okay, wanted to do one more method, and this is kind of a total capital aggregate method. So I took the capital in year-end 2019, which was $5.74 billion, and then looked at it at the year-end of 2011, which was $1.34 billion. And I looked at the difference. So I had a total capital growth of $4.4 billion. And so I was saying, like, okay, well, my total capital growth should be close or should equal the amount of capital that I added over time. So if I look at the capital that I added over time, you know, it should equal the total growth capital plus maintenance capital. Something wasn't quite adding up though, and this is where I went back to my anomaly that I had earlier, where you could see my sales to capital ratio was in the high 3s to mid 3s, and then all of a sudden dropped off to the low to high 1s. And that's when I actually Googled, is like, what happened with Alaska Airlines? And I was like, it looks like there might have been a merger or an acquisition. And sure enough, they bought U.S. Virgin, I think it was in 2016, and they ended up paying a premium for the shares. And as a result, you can see here this figure of $2.06 billion in goodwill that ended up on their balance sheet. We won't get into all the nuances of goodwill right now, but basically, I interpret this as they overpaid for that airline. And so, you know, those dollars aren't really doing anything for the company. So that kind of makes me call into question whether or not my 2.57 number would be a good sales to capital ratio for the marginal dollar, for the next dollar that goes into the company. Because I think that ultimately a new dollar into the company, into new planes, is probably going to yield more sales because it's not getting a deadweight loss like this goodwill did. Anyway, so once I account for the goodwill, I get the incremental capital added, which this should be the growth capex over that period of time. And so that should include, you know, fiscal years starting at year end 11. So we won't include the year end 11 numbers, but it'll go up to and including 2019. So we will include the 2019 numbers. So the math is a little different on this one than it was on the previous aggregates. You just got to make sure you're putting the right numbers in the right method. And so it looked at the Capex applicable to that period. I took out this total Capex from that Capex to get my implied maintenance Capex. So that was over the time period. The implied maintenance Capex, I took the total depreciation of the same time period, and my implied maintenance Capex was about 125% of depreciation. That's closer to the sales to capital ratio, but a little bit less. And so what I think it would be closer to a sales to capital ratio if I adjusted for the merger, which we'll get into that in a bit. All right, hope you're doing well so far. Ladies and gentlemen, welcome to the varsity level. All right, so I still am trying to find a good estimate for maintenance capital expenditure for Alaska Air Group, and I have this problematic merger. So I want to look at what is maintenance and growth Capex going to look like going forward for every additional dollar put into the company organically as opposed to mergers and acquisitions. So I want to treat the merger as if we had paid the market value for the assets. So what I did is, I still have my total capital here. I added in the line of goodwill. And so what I did is I backed out the goodwill, which was recorded on the balance sheet for those years. And so I came up with something called adjusted total capital. So I used my adjusted total capital over time, and then I recalculated my adjusted, my year-over-year capital growth, called it adjusted year-over-year capital growth. So I've got that. And then I have my original line of sales to capital in here, but then I recalculated the sales to capital with the adjusted numbers. And you can see here, they're a lot more smooth. So it makes a lot more sense to me. And if you look at the average over time, it's actually a lot closer to those original numbers that I was looking at, when I said that it was in the low to high threes, and then it dropped off to the ones. So if I back out the goodwill and just write that off as, okay, maybe the company overpaid for Virgin, and hopefully they won't do it again, then every new dollar that goes into the company, I can expect to get $3.15 dollars of sales coming in the future for growth capital expenditures. There's good news and bad news to this. I mean, the good news is that I'm going to get more bang for my buck of new capital going to the company, but the bad news is they made a bad decision potentially. I mean, you may disagree with me. Some other people may disagree with me. It may have been a strategic decision, but on paper it looks like they paid too much money for that airline, and it looks like it took a toll on the stock, on the company's assets, and their ability to be efficient with their use of capital. So I guess the potential bad news is that, are they going to do some more acquisitions that are potentially value destroying? Interestingly enough, if you look at the research, most acquisitions are value destroying. Professor DeMordran in his corporate finance class talks about that's actually one of the signs on his checklist to sell a company. It's like if a company starts to do large mergers and acquisitions instead of trying to grow things organically through their own internal projects, he'll sell the stock and won't look back, which I thought was pretty fascinating. So moving on, I used the new numbers, the new sales to capital numbers, to come up with new implied growth capital expenditures. Same way that I did before for the sales to PPPE and sales to capital methods that I used. So basically just take the incremental sales and then divide it by my average number for the sales to capital ratio. So I used that 3.15 number there. Then I again put down my actual capital expenditures that we had on the cash flow statement, and I subtracted the implied growth to get my implied maintenance capital expenditure, and put depreciation down so I could compare them. So at the end of the day, I see it looks like I've got over $4 billion of maintenance capital expenditure, where I had during the same time period about $2.52 billion in depreciation. So a good bit more than depreciation. Now going back to our previous method, I wanted to normalize this. So I looked at the implied maintenance capital expenditure as a percent of sales. And instead of averaging the averages, I used the aggregate method and looked at, had my total sales applicable to the position, fiscal years 12 through 19. And I went ahead and came up with the percent of sales that our total maintenance capex was that we spent in the time. And so I'm going to use that number to do my 10 cap. That is ultimately the number that I will use in my normalized 10 cap going forward. Okay, let's put it all together. So we've gotten our maintenance capital expenditures, we've got our normal margins, and so I put it all here to kind of sum up. So we're going to go from base point of 2019 sales. So I put the 2019 sales there. So sales are 100% of sales by definition. So we used the normalized averages for our margins over the last either 8 or 9 years, depending on the metric. So net income, it was about 9.82%. Depreciation, I went ahead and recalculated that because I don't think I'd gone over that yet. It was about 5.37%. The non-cash was just under 2%. And then the maintenance Capex was a little over 8.5%. So using 2019 as a proxy year, I calculated what those numbers would look like here. Remember, we're going to begin with the net income, add the depreciation back, add the non-cash, and then subtract the maintenance capital expenditures. And so I get a normalized cash flow of about 755 million, which is slightly less than the, or moderately less than the net income. So I had the common shares in 2019, which was 123 million. It gives me 614 in free cash flow per share, or 10 cap price of 61.40. Now you're like, well, hang on a second. What happens when something like 2020 happens and all hell breaks loose? You know, we didn't even know if the airlines were going to survive, and they still may not survive. So this is where you can basically ask yourself, well, when is Alaska Air Group going to have another normal year again? And so if you think that perhaps they'll get back to 2019 levels, and that's kind of a good proxy to use, is when will they be back to 2019 levels? When does that look like? Maybe the vaccine takes off, things go really well this year, and next year they're right back where they left off at 2019. So that's kind of this case that I used right here. So what I did is the 10 cap, you multiply it by 10. So I just adjusted it for the havoc from 2020 by, let's say it's 0 this year. And we go forward and we get the price in that case of 55. Maybe they continue to suffer this year and they have some losses like they did in 2020. And then they only partially recover in 2022. And then we finally get back to the normal year in 2023. And then recalculate the price there. Basically just sum up this line. And you can see instead of doing 10 of the same thing, I've just adjusted those 2 years. I get 48.12. And then perhaps things are even worse than that. Maybe it's going to be just another write-off year. 2021, we're going to lose $5 a share in free cash flow. We'll break even in 2022. We won't quite be recovered in 2023. And then in 2024, we see a year that looks like 2019 again. And so then I get a price of about $42. You got to ask yourself, though, what else can change here and what else is going on in the valuation? Because remember, all these numbers are under the implicit assumption that the share count is going to be 123 million. You had airlines taking government aid. You have airlines still taking government aid. Those airlines may get diluted. That share count could double. It could triple. The shareholders could be wiped out completely. The bondholders may take control of the airline. The bondholders may get wiped out. It could go under. Those are things you're going to have to look at in your valuation to make sure that your assumptions are going to stand the test of time going forward. But basically, in order to normalize your 10 cap, you have to create a story about your company, your business. So in this case, Alaska Air Group, you've got to create a story and you've got to say, you know what, I think they're going to make it. I think the share count's not going to be diluted. Here's why I think that. I think they're going to have a normal year like 2019 again in 2022. COVID vaccine is working well. There's a lot of pent-up demand for travel. 2022 is going to look like a normal year. It's my year. Whatever your story is, lay it out. Make sure it makes logical sense. Compare it to the real world, other factors if you can, and then translate it to numbers and put it down. So that's a technique that you can use, to modify your 10 cap. But I mean, at the end of the day, there is no, like I said, no stock picking genie, no one right answer. It's both art and science. It's skill in valuation. Just make sure that your valuation is consistent. Make sure that your assumptions will hold up in reality, and make sure that you continually take a look at it and check yourself and reevaluate it. And the more you do it, the better you will get. Thanks for following along, and I hope this video has been helpful. If you have any questions, please feel free to email me. I'll put my address in the notes. And I'd be happy to help. And if you see any errors or any other problems or disagree, I'd love to hear it. I can only get better if I take feedback. So thank you very much and have a good day.